Robotics is a huge growth opportunity, like you didn't know. Right now, the robotics market is predicted to triple from today's levels to over $200 billion by 2030. That's because AI is predicted to accelerate automation across manufacturing, healthcare, logistics, and defense. That's why today I'm going to share 6 robotic stocks that could prove to be tomorrow's next big winners. If that sounds like the type of thing you want to hear more about, then do me a favor and hit that like button right now. It takes 1 second and it tells YouTube to send you more data-driven stock research like this in the future. Now, let's start with a company that protects the entire robotics build-out from the inside out. I'm talking about Littelfuse with the symbol LFUS. But first, we got to take care of a couple quick things. First, remember that this isn't personalized investment advice. Investing always carries risk, so do your own homework before you buy or sell any stock. Second, I should tell you who I am. I'm Steve Reitmeister, but all my friends call me Righty. Spent nearly 20 years as editor-in-chief of Zacks.com, and now I'm a partner at WallStreetZen, where our quant model analyzes stocks by 115 unique factors to find the ones with the best shot at beating the market. Indeed, all 6 of the robotic stocks today scored very highly in that same quant model. Back to Littelfuse. They make circuit protection, power control, and sensing components. These are the things that keep electrical systems from frying themselves. Every automated factory, warehouse full of machines, and industrial robots depends on reliable power and protection. That makes this a genuine picks and shovels play inside the robotics gold rush. Picks and shovels is another way of saying essential. And that is essentially what Littelfuse is proving to be. This shows up prominently in their string of 5 consecutive earnings beats. Now, history shows the more a company beats in the past, the more likely it is to beat earnings in the future. Wall Street analysts are most certainly bullish on these shares as well. Every single analyst covering the stock recommends it as a buy, not even a tepid hold in the bunch. Gladly, the fair value price target suggests the stock could see much more significant upside in the coming year. This bullish story is echoed by the Zen Ratings quant model, where the full 115 factor review helps locate stocks likely to outperform. That is most certainly the case for Littelfuse, which earns an overall A rating, which equates to a strong buy recommendation. That stellar grade owes the fact that it ranks in the top 2% of more than 4,600 stocks tracked based upon its sterling fundamentals. Each overall rating is composed of 7 underlying component grades, so let's look to those to appreciate the stock's unique strengths. In this case, we're talking about being in the top 15% of all stocks for safety, and then top 13% for growth, top 11% for financials, top 8% for sentiment, and the top 5% for momentum. When a stock scores that well across the board with no single glaring weakness, that's the signature of a very strong operator that usually keeps banging out more earnings growth in the years ahead. The risk here is that a chunk of Littelfuse business is tied to the auto and industrial cycles, so if manufacturing slows, then demand can most certainly soften. Not an imminent red flag, but something to keep an eye on down the road. But as the company protecting electronics inside the entire robotics and automation wave, with a 5-quarter earnings beat streak, unanimous analyst support, and a truly stellar Zen Ratings profile, then Littelfuse is a strong way to open up the stock list. But I bet you've never heard of the next one, which makes an exciting hidden gem pick. But before I reveal that, if you want to discover more under-the-radar stocks like this, then the best thing you can do right now is to sign up for my next live training session this coming Monday. The focus is on timely market insight plus my top stock picks. Now, it's totally free, but you do need to sign up. Do that now to join this coming Monday at 7 p.m. Eastern Time. Just go to wallstreetzen.com/live. Our second stock is exactly the kind of under-the-radar company this list is all about. We're talking about iTest with a symbol of INTT. Before a chip goes into a robot or a self-driving car, it needs to be tested. That's what iTest does. And thanks to a recent acquisition, it now also builds robotics-based testing systems, putting it right at the heart of the automation boom. The excitement on that front comes through loud and clear in the consensus estimate of 130% earnings growth expected in the year ahead. That is roughly 7 times faster than the industry average, which is the start of the appeal to this stock. The Zen Rating shows you the rest of the appeal, as iTest scores an overall A rating, which makes it a strong buy recommendation. That means its fundamental profile is in the top 5% of all stocks. Things look even better under the hood with a strong slate of component grades. They rank the top 5% of all stocks tracked for momentum. That improves the top 3% for growth, which is about the consistency of growth, which portends more earnings beats ahead. And finally, we slide on up to the top 1% for sentiment, which says the stock may be under the radar to us, but the smart money is already on board. The component grades are not all sparkling. We have a slate of middle-of-the-pack C grades for value, safety, and financials. But then again, this is typical for a company this small, including the low safety grade, which is about more volatile price swings. Gladly, that also means it can explode higher. But as a tiny, fast-growing company sitting right at the testing choke point of the entire chip and robotics supply chain, ITTT is a fascinating early-stage idea. As such, it may be a strong contender to add to your free watch list on WallStreetZen.com and see where it goes from there. Now, without our next pick, the entire robotics revolution would literally grind to a halt. I'm talking about stock number 3, which is Helios Technologies with a symbol of LHIO. Before a robot can do anything useful, it has to move. And Helios makes the motion control systems that turns commands into movement, a pretty vital step in robotics. Right now, Helios appears to be shifting into high gear. After several flat years, earnings jumped more than 65% last year as the business bounced back to growth mode. It's also been beating Wall Street earnings estimates for 5 quarters in a row. Once again, we have a stock scoring highly in the Zen ratings model. Their A rating comes from being the top 4% of stocks for its attractive fundamental profile. Now let's look at those component grades to appreciate the unique strengths and weaknesses of this investment proposition. Helios lands in the top 17% of stocks for safety. Then we have top 10% for growth, and the two strongest areas are their top 9% showing for momentum, followed by top 8% for sentiment. There's a lot to like in these results. The risk is that a lot of Helios's end markets, like construction and agriculture, are quite cyclical. When those industries slow, Helios will likely feel it as well. But as the company providing the actual muscle behind industrial automation with an accelerating turnaround, Helios is a compelling pick to consider right now. As we move on to our next stock, we have another backbone that ties the whole automated world together. That leads us to a name you already know, and that's Hewlett Packard Enterprise with the symbol HPE. It may not seem like a robotics stock at first glance, but robots need fast, reliable computing and networking to communicate and operate at scale. And that's exactly where HPE comes in. That's especially true after their Juniper Networks acquisition, where they are building the intelligent infrastructure that powers the automated economy. The numbers have truly taken off. According to current estimates, their earnings are forecast to grow by more than 50% annually, powered by a booming networking business. Growth is nice, especially when it's combined with value. That shows up clearly in their PEG ratio below 1, suggesting shares are currently undervalued relative to that impressive growth prospects. Here again, we have a company flexing some muscle with recent earnings beats. In this case, they are riding a wave of 5 straight earnings beats, and the most recent beat was a big one. Wall Street sees a lot more upside in the card. Not only do they enjoy a strong slate of strong buy and buy recommendations, but even more impressive is the fair value price targets, according to 80% potential share price gains in the year ahead. This may be a more well-known stock, but that doesn't stop HPE from being one of the top-ranked stocks in the Zen ratings model. This is truly an elite pick, scoring the top 1% of all stocks for its impressive fundamental profile. Remember, these Zen ratings are updated daily, so for the most up-to-date information on this stock or any other, just enter the ticker in the search bar on WallStreetZen.com. Once again, the component grades reveals a lot to like in this stock, starting with the top 19% showing for value. Then we have the top 9% for momentum. Coming down the home stretch, we have a stellar top 3% of all stocks for sentiment and then top 2% for growth. What a combination, especially the blending of growth and value. The main risk is that HPE still has a legacy hardware business that grows slowly. So the AI, robotics, and networking story has to be carrying all the load. Any slowdown there will be harmful to these shares. As the biggest stock on our list, it still greatly impresses with ample Wall Street support and a top 1% fundamental profile according to Zen ratings. No wonder analysts are pounding the table for so much more share price upside in the year ahead. By the way, if you're getting value out of this video so far, then take a second to subscribe and hit the notification bell. I put out fresh stock breakdowns like this every week, and subscribe and make sure the next batch of top stocks actually shows up in your feed instead of getting lost in the shuffle. Now let's keep moving with stock number 5. Here we have perhaps the purest robotics play on the list in Cognex with the symbol of CGNX. The company is a global leader in machine vision, which means they build the camera and software that lets robots see and make decisions. So if a robot has eyes, then there's a good chance Cognex built them. And yes, the business is truly firing on all cylinders. This shows up in spades in their most recent earnings report, where earnings more than doubled year over year. On top of that, Cognex is riding a 6-quarter earnings beat streak. On top of everything else, they recently launched a new generation of AI-powered vision systems, some built on NVIDIA's technology, which puts it right at the center of where this industry is heading. Wall Street pros are lining up behind these shares, given that it enjoys a consensus strong buy recommendation. These aren't just rando analysts. There are many top-ranked analysts who are amongst the elite stock pickers in the world, meaning their recommendations count more than others. This is our first stock to score a B rating, which, according to the Zen ratings, which still accounts for a buy recommendation. That's not much of a downgrade when you appreciate that it's still in the top 9% of all stocks based upon its fundamental profile. Now let's look at those component grades. It ranks the top 15% for momentum, top 14% for growth. Better yet, we have top 8% showing for sentiment and top 7% for financials. That's a strong core of fundamentals, especially growth in financials that increase the odds of more earnings beats ahead. But value is the problem here. It's a real one, as evidenced by the D grade, putting in the bottom 20% of all stocks. After a huge run-up in shares, the stock has gotten expensive relative to growth. That's the honest knock on this company. But as the undisputed leader in giving machines the ability to see, with the longest beat streak on the list and brand new AI product cycle just getting started, Cognex is an exciting pick to put on your radar screen right now. Before we get to that final pick, one quick thing. If you want to stay one step ahead of the market, then join me live every Monday at 7 p.m. Eastern Time. This is when I detail my updated market outlook and trading plan to outperform. This is also when I share my trade of the week based upon the proven Zen ratings quant model and my greater than 40 years investing experience. It's a free event, but you do need to register. Just go to WallStreetZen.com/live or click the link in the description or scan the QR code on your screen. Just pause the video for a moment to sign up, and then I look forward to seeing you on Monday. Now get ready for the final pick on the list today. This last name takes robotics somewhere you might not expect. That brings us to Align Technology with a symbol of ALGN. This time we're leaving the factory floor and heading to the dentist's office. You likely know this company for its Invisalign product, but behind the scenes, the entire treatment process is highly automated. Digital scanners create a 3D model of your teeth, software designs the treatment, and automated manufacturing produces custom aligners. It's a robotics-driven healthcare business hiding in plain sight. Even better, the stock is down significantly over the past year despite continued business growth. This is a disconnect that could create an exciting investment opportunity. And that does appear to be the case here because the business is indeed healthy. Align's earnings are forecast to grow over 30% a year, much faster than the rest of its industry. With the stock out of favor, we need to do the 115-factor deep dive of the Zen ratings to make sure we are looking at a healthy company. Here we see that Align earns a coveted A rating overall. In this case, it's actually in the top 1% of all stocks for a truly stellar fundamental profile. The component grades are impressively balanced, starting with sentiment in the top 19% of all stocks. Then we have top 17% for our artificial intelligence factor, which is our AI-powered algorithm that works through mountains of data to detect subtle patterns that indicate likely future share price outperformers. Then coming down the line, we got top 16% for growth, top 11% for financial strength, and both top 7% for value and safety. That is strong across the board. The one weak spot is momentum with a middle-of-the-road C. That makes sense given the weakness of shares the past year. That may scare away some investors, but actually spells opportunities for those with more of a focus on value. The main risk is that Align's growth depends on consumers feeling confident enough to spend money on elective dental work. So a weaker economy would likely weigh down results. Gladly, that does not seem like a threat on the near-term horizon. All in all, we have a company using automation to dominate their industry. Beyond the growth, they have a sparkling fundamental profile. Even better is the share price weakness that spells opportunity on the value front. That makes Align a great choice to close out our stock list today. So there you have it. 6 ways to play the robotics build out, from the components and the vision systems to the motion controls, the networking backbone, and even automated healthcare. Every one of these selections came straight out of the data and tools on WallStreetZen.com, including the 115-factor review of the Zen ratings model. Remember, the Zen ratings changes daily, so be sure to check back in frequently for the most up-to-date data on our free quote pages. Just type any ticker into our site at WallStreetZen.com. Okay, now I want to hear from you all. Which of these 6 stocks caught your eye, and are there any robotics tickers that you're bullish on that I didn't cover here today? Let me know down in the comment section below, and maybe I'll cover it in a future video. Speaking of more videos, I've got an idea for your next watch. Check out the video that's popping on your screen now. In that one, I break down the 4 stocks I believe could create generational wealth by 2030.